Hey, this is Katie Mountain with Colletta Street Capital, and today I'm going to be talking to you about basics of notes. Last night I was a guest speaker at Reno's Real Estate Investors Club, and I had a whole presentation on what are notes, and then I went into how to get a note. So basically all the due diligence that you have to do so that you make a good investment. And I spoke for about an hour, and people were taking notes and they were very excited. I'm sure they were overwhelmed because I presented a lot of information. And looking back, I think it's important when we do a presentation or when we make a video or when we do a podcast that we reflect on what we did and what we could do differently next time. And so last night and this morning and today, I've been really thinking about how could I have met their needs more. And so I think I skipped an important step for them, or I went quickly over a step. And a lot of their questions reflected the fact that I went over, there was assumptions I made that they knew about. And so I thought it would be important to make this video, so that in future, if I do get to present, I could present this topic or this idea. So I want to make this more of like a 3-part series. So break down what I did last night at the RIA into 3 different parts. So part 1 is basically note basics. I'm calling it choose your own adventure, and just getting to know what notes are, what you can do with them, and what is the outcome for you and your investors when you do them. So that's what we're going to be talking about today. So it's very basic notes, so that you understand what your options are. So you get to choose your own adventure in a sense of what notes are. So the first question I went over yesterday was, what is a note? I asked people, how many know what a note is? How many people have used or invested in notes? And there were very few hands going up. And so we talked for a while about what is a note, but pretty much today we're going to be really spending a lot of time on what is a note and what you can do with a note. So basically a note is a piece of paper. It is a legal document, but it is literally a piece of paper that says note on the top. And it does go hand in hand with a mortgage. I guess in past, they were created together, but people would sell them separately. So someone would have the note and someone else would have the mortgage. But you want to make sure as a note investor that you always have both together. And also when people say that they invest in notes, they're not just saying they invest in the note itself, it's the mortgage and the note combined, and that whole collateral file is what they've invested in. And so if you are a note investor, you are investing in the mortgage and you are investing in the note, but we just call it a note. What the note focuses on, which is a little different than the mortgage, it focuses on the money aspect of the loan. So when you see a note, it's going to talk about, it's actually a promise to pay is what it is. And it says at the top, number 1, promise to pay, who you pay, when you pay, how much you pay, what happens if you don't pay. It's several pages long, the document that you sign. And it's one of those big stacks of documents that you sign when you buy a house. The mortgage is in there, the note's in there, and then there's a whole bunch of other papers that you are signing. But the note is one of them, and it is the important one in a sense because it's telling who you're paying, what your interest is, and everything like that. So here's an example I got off the internet of what a note, and notice it says note on the top. It actually says note. And then number 1, borrowers promise to pay. And it says they will pay this much to so-and-so. And then it goes into what their interest will be and how many their payments. And this is 2 or 3 or 4 pages. If they're right to repay, what happens when they don't pay? How long do they have before they get late fees? What are the late fees? So this all goes into the note. And attached to a note, so let's say this was originated with, I don't know, what's a bank? U.S. Bank. So U.S. Bank originated the loan. So they wrote up the note and you sign it. or you sign it. Well, or someone signs it. The borrower signs it. This note gets sold. They bundle it all up and they take good notes and they take bad notes and good mortgages and bad mortgages, and they sell them as a bundle. And this note gets sold. Well, what happens when this note gets sold, the next person who buys it is not going to make the borrower sign a whole new note. So what they're going to do is create an allonge. And this is what this is right here. It's called an allonge to the note. And it basically says that person A is now to be paid because they bought it from US Bank. Okay? And then when person A wants to sell it, they sell the note to person B and create a new allonge. So the new allonge now says that person B owns it and they bought it from person A and they are to be paid, and so on and so on. And when you buy the note, you need to have an allonge that now says you are the owner and you will be paid, if that makes sense. So when you look at a collateral file, you want to make sure that the allonge is not broken. You want to make sure that this chain goes all the way back to the original loan, and then it goes all the way to you. If there is a gap of ownership within there, it's not, from what I understand, it's not difficult to fix, but you do need to fix it because when it's hard to go to foreclosure, if the foreclosure has a good lawyer, they can easily stop it based on paper. Now, it's the same with the mortgage. So the mortgage is like this. It says mortgage at the top, and then it has an assignment or an AOM, assignment of mortgage. So every time it's sold, there's a new assignment of mortgage that attaches to it. And you want to make sure when you buy it, well, you will get one. And that's what you have to record with the county, that you now own the note. But you want to make sure that there's no broken chain in that. You do not have to record the allonge, but you do have to record the assignment. But it's very similar to the layout of these also. So that's why I didn't put it in. Most people have seen a mortgage before, but notes are always but notes are funny because it literally says note on top. So when you invest in notes, you have many different avenues that you can go down and different ways to invest. And when you do invest in these different ways, you also have different outcomes that you can choose and directions and paths that you want to take based on what you want out of note investing. We invest in first liens. There are many people who invest in second liens. We are not going to be talking about second liens today just because I don't know enough about them to talk about them in an educational sense. So we will be focusing on first liens. We will also be looking at performing notes and non-performing notes and reperforming notes. So there's many different, you can choose to invest in performing and non-performing. Some do both, some do one and not the other. So a lot of the people I run into who don't know much about notes but have invested, invest in performing notes and are stuck because it's gone non-performing and they don't know what to do. So today we're going to talk about some of the strategies and what you can do with these notes and how that affects your outcome and your return of your interest of your money, right? So we're going to be looking at first performing. So performing notes, you pay more for them. You're going to pay 85 to 100% of the unpaid. Oh, I need to fix that. It says UBP. It's UBP. I'm sorry about that. Unpaid balance, UPB, or the fair market value, whatever's lowest. You are going to get monthly payments from the P&I. So those of you who are not aware, there's the P&I and then there's the T&I. So the P&I is your principal and interest, and that comes to you, the note, like the bank. You are the bank now, right? So the borrower is going to pay their full mortgage, which is the P&I and T&I. The T&I go into an escrow type account where they are one goes in and pays for the insurance, and one goes in and pays for the taxes. And so it's kind of saved up every year, and then when it's tax time, they get paid. So the homeowner doesn't have to worry about actually mailing in their check on time to pay for taxes, because they pay a little bit every single month to pay for their taxes. The P&I is the principal and interest, and that goes to you, the bank. So when we talk about the money that you're getting, the borrower is going to write one check to your servicer, and you will get the P&I part of it, is what happens. So you're going to get that monthly with a performing note. So you're going to have that steady cash flow, right? Which is really nice. The cost to you to manage it is very low. It's a boarding fee. And I could probably be boarding fee of $20, $30, $40 at the most, to board a performing note. So it's a lot cheaper than boarding a non-performing note. So here's just a quick example. $1,000 minus 30. Okay, so let's say the $1,000 is the P&I that you get, and the $30 is your boarding fee. So you now are getting from your servicer monthly $970. If you have a joint venture partner, a JV, you have to split it in half, and so you each get $485. But if you're using your own money, you get the whole $970. So the good part about performing notes is that they're performing, and that you're getting monthly cash flow, right? Okay. The bad part about it is you have to be willing to be invested for a longer period of time. Because if you think, let's say the unpaid balance is $50,000, or you paid $50,000 for the note. Okay. Whether that's 85, 90, 100% of the unpaid balance, you paid a total of $50,000. Well, if you're getting a monthly payment of the $1,000, right, or really $970, because after boarding fees, then it's going to take 50. Let's just round up $1,000. So it's going to take 50 months to just get back the investment that you made. So, so that's a long time in the note world to just get back your money, your principal. You haven't even made money off of it, right? So if you are investing in performing notes, there are people who are just willing to have their money tied up for a longer period of time. And it's nice. And if you have several, 2 or 3 performing notes, 4 or 5 performing notes, and they stay performing, that's a nice monthly amount coming in every single month to you on a regular basis. Okay. But you're just going to have to hold on to it longer in order to get a return on your money, on your investment. So non-performing notes, those NPNs, you're going to pay less money, 35 to 65% of the unpaid balance or the fair market value. You're not seeing much 35 anymore unless you're getting like a contract for deed. But most are up around 50, 55. I would say we usually don't ever pay 65 unless the numbers really work out, because it's just you don't make enough money off that for you and your investors anymore, and it just doesn't make sense for all the work that you put in to make such little amount of money. So the cost to manage is a little bit higher. So you're going to have the boarding fee. I know at Madison Management, I think it's about 40. FCI is 95. FCI includes a lot more though to it. So they do a lot more of the borrower outreach with that 95. They're doing the skip trace and all that kind of stuff. With the $40, we had to find a special servicer to do a lot of the borrower outreach for us. And that can cost anywhere between, $400 to $1,000. And that's just for several months. And it's very intense borrower outreach to get that person reperforming again. If they're not paying their mortgage, they're probably not paying insurance. So you want to get it covered right away until there's proof of insurance. So forced place insurance. And there's also taxes a lot of times. You as the owner of the note do not want to let the taxes not get paid every year. So sometimes when you buy a note, there's going to be taxes owed. And so you want to pay those right away because you don't want a tax lien and you don't want it to go to tax sale. And you want to pay yours every year. I did have recently learned that you can, if you are paying the forced place insurance and if you pay the taxes, you can bill it to the borrower through your servicer. So you can add it onto the amount, their unpaid balance. So it would add on to like their total unpaid balance. kind of like how you would add on legal fees and that kind of stuff. So it adds on, which is nice, that eventually you might get some of that money back through that way. Just remember that every exit strategy has a different ROI, and so it's really important to think about what your exit strategies are. And every note is different too, and every note, even though you want to do one strategy, you might not be able to do that strategy with them based on the borrower, based on their history, based on the house itself. So you really have to think about before you purchase the note, what the exit strategy is, and if you're okay with that exit strategy. And if you're okay with the ROI that comes with that exit strategy. So here's just a few, like literally just a few of the non-performing strategies. And there's different strategies, whether it's occupied or non-occupied. But to reinstate, whether full or partial, a short payoff, to modify, cash for keys, deed in lieu, and foreclosure. And if you're doing a foreclosure, are you going to sell it? Are you going to rent it? Are you going to make sure it sells at auction, or do you want it back as an REO? So there's lots of different exit strategies that you really have to think about with each note and what your business wants. And these are just to name a few. There are so many creative and unique ways that you can work with the borrower to help them stay in their house and to help you get your money and get your investors their money. So there's a lot of really creative, that's why I kind of call it choose your own adventure, because there's so many ways that you can help your borrower out and still help yourself out. One of the RIA members came and talked to me because 2 houses down from him has a house that's vacant, and it's in the foreclosure process, and it has all the foreclosure papers up on it. And so of course it has the lender on those foreclosure papers. So he has been calling nonstop to the lender because he wants to buy it because he can't find the borrower. He doesn't know where the borrower is, and he doesn't know their full name and everything to contact them. So he's been, I guess it's on the door too, but he can't find them. I helped him try to look through like white pages and stuff like that. I suggested skip trace. I don't know if he's done it yet or not. But he wants to try to buy it either from the borrower or buy the note. So he's been contacting the lender to try to buy this, for the lender to sell the note to him. So he's been calling specifically to that lender. So that's an interesting strategy too, is if you have a house that is foreclosed in your neighborhood and you don't want a foreclosure in your neighborhood, and the house has been sitting empty, I think for like 2 years now, and they all have been like taking care of it, and the HOA has been taking care of it and making sure it stays nice. Going to the lender itself to see if they'll sell you the note is an interesting strategy too. So many different strategies out there. Just know which ones you want to do, because that's going to help you know what your ROI is going to be. So we're just going to talk about 2 strategies today. So we're going to talk about reinstating and foreclosure. So reinstating is pretty simple. What they do is they are either going to pay an amount that's partial to catch them up, or the whole entire part that they're behind. So if they're behind $5,000, $10,000, the problem is with reinstating, a lot of them don't have the money to fully reinstate and then start paying the P&I right away. And so you have to take that into consideration. Where are they getting this money from? Are they going and borrowing it from somewhere else? Does that mean they're going to continue to be able to pay their monthly payments? So looking at maybe partial would be better than a full reinstatement, just so that they can continue to make their monthly payments, right? So they pay some amount at the beginning, and then they start paying their P&I, which is their principal and interest. And after about 12 months of them paying consistently, meaning every single month for 12 months, you can sell it as a reperforming note, which means that you can sell it for 80 to 85% of the unpaid balance or the fair market value. And that's going to be different from the year ago that you bought it. So just keep that in mind too, that prices, and if they're paying for a full year, their unpaid balance is going to be changed also. But a quick rough way to find that out is a P&I times 12. So if they're paying $500 a month, it's $6,000 divided by the purchase price that you paid for it. That gives you a rough estimate for what your ROI is going to be if they reinstate. A more accurate one, which gets into a lot of the nitty gritty, but I think it's important to look at the nitty and gritty, is the money up front. So this is based actually off one of our contract for deeds. So it's a little different than a actual note, but it's more like a rent to own. So $5,000 they paid up front right away. Well, they paid 1 month, 2,500, another month, 2,500. And then if they would have continued, they would have been paying after 12 months, it would have been about $6,000. They stopped. They could only pay a couple months because I think that $5,000 was too much for them to pay at one time. Even though we did break it into 2 portions, I think we should have broke it into more so that they could have been able to continue paying it. Then whatever your selling price is, so what did you sell it for, the 85% of the unpaid balance? So 85 of it is $42,500. And then we're going to subtract your managing costs. So your managing costs are all the things we talked about before. And then you're going to divide it by your purchase. And we paid $15 for it. And that equals about a 31% ROI on our investment, which is pretty amazing considering all that has happened. Now, if that would have happened, that would have been nice. But right now we're having to go through the eviction process. So unfortunately, we're not able to sell it. And so it'll have a different ROI based on that. If you have a partner or JV partner, you would have to split that, right? So 50-50. If they go through the foreclosure process, it's not as easy to calculate the ROI, but you do need to learn about the process in that state. So you want to know about the process, the length, and the expense for that state. You want to know if they have a right to redemption and how long that is. Tennessee has 2 years right to redemption. So if you're buying a non-performing note that probably is going to foreclose in Tennessee, know that you're not going to be able to sell it. You're going to have to rent it for 2 years before you can sell it. So that's just things to take in mind. And if you're okay with that, that's awesome. Or if you're pretty sure that the person's going to reinstate, that's awesome. But you just need to know and educate yourself on the state and the county in which you are purchasing the note in for foreclosure. Your lawyer is going to be about $3,000 to $5,000. So you have to keep that in mind. If you get it back, if it does not sell in the foreclosure auction, you get it back, you have the rehab cost. And that could be anywhere between just paint and carpet to new appliances, to things that have been stolen, things that have been damaged. You could try selling it as is, but then you're going to get a less money at the sale. You can sell it at the foreclosure by the way you price it. If you want it to sell, you can price it to sell. And then you don't have to worry about rehab. You don't have to worry about the realtor fees. And it cuts out a couple months of time because if you get the house back as an REO, it takes several months. And then if you have to actually evict the person, that's another month. And then putting it on time on market to sell it, realtor fees. So it all depends on what your exit strategy is, but these are all things to take into consideration with your ROI for foreclosure. So we take the sale price, what you sell the property at. So you either sold it at foreclosure or you sold it on MLS. And so that price minus your cost, right? So there's always the realtor fees, the other costs, your foreclosure costs that are there, any other expenses that you had to pay for. Maybe that's, the lawyer fees would be in the foreclosure cost, but any other expenses that you had to pay, any rehab, all your servicing, all your insurances that you've paid, anything like that, that all goes subtracting from your sale price, and then you divide that by the purchase price, and that'll get your rough ROI for what you're going to make on the foreclosure. So these are just 2 examples of the paths that you can take and what you can do with notes. And there's, like I said, so many different paths to choose and so many different great ways that you can work with your borrower. So here's just a little flow chart on all the ways. And if you do this, then you can do this and this, or you could go this path and this path, or this path, and this path. And they all take you to a different spot. But hopefully whatever your goals are in whatever you have, your goals are that you have in mind. So really choose your own adventure is the idea for today. So today was just a basic note basics on what a note is, what it looks like, what you can do from it, and what you can expect from it, I guess, in a sense, for the ROI at least, with the notes. So now that you know a little bit more about notes, the next video, part 2, is all going to be about how to get a note with the due diligence that you do, and make sure that your investment is a good investment with all that due diligence. And so today's is going to end here, but the next part, so stay tuned next week for part 2, and that's all going to be on note basics due diligence. If you have any questions, please email me or call me. I know I'm not presenting live, so I can't really answer your questions right now, but email me or contact us on all those. I'll show you all the places you can contact us. I'll get there in just here. I'll get there in just a second. If you haven't watched, Scott Carson has an amazing podcast for the Note Closers show, and he's just doing a great job and getting so creative with all the different things that he's doing with it. And we were able to, when he went to Europe, help him out and be a guest host on the Note Closers show podcast. So check us out. We were 281, 282, and 290. And then a long time ago, Scott Carson interviewed me on the Note Closer Show podcast when we first started, and I was episode 180. So go check that one out also. Here's our contact information. There it is. So you can contact us on LinkedIn, Facebook, YouTube, Instagram, Colletta Street. You can even, if you're watching this on YouTube, you can put the questions down below on YouTube, and I will get back to you if you want. Or you can email me at katie@colettastreet.com, and I can respond. You can call 775-525-1222. Again, my name is Katie Moten, and this is Colletta Street Capital. Happy note hunting, and hope to hear from you.